Hey everyone, welcome back to the channel. Today we're talking about one of the most explosive AI infrastructure stocks in the entire market right now, Credo Technology Group, ticker CRDO. The company has been on an absolute tear, but the big question is whether this is real, sustainable growth, or just hype driven by AI excitement. And more importantly, is Credo worth investing in at today's elevated price levels? In this video, we're breaking down exactly what Credo does, how fast it's growing, why the valuation is so high, what the Nvidia executive news means, the risks you need to know, and more. Let's get into it. This video is created solely for educational purposes. It should not be considered financial advice, and viewers should conduct their own research or consult a licensed financial professional before making investment decisions. Credo Technology builds the ultra-high-speed connectivity systems that allow data to move rapidly inside AI data centers. Instead of designing GPUs, the company focuses on the critical communication layer that lets GPUs interact with each other at extremely high speeds. Their products include SerDes chiplets, active electrical cables, advanced optical transceivers, and a high-bandwidth data architecture called OmniConnect. These technologies eliminate bottlenecks inside AI clusters, and with AI workloads requiring massive bandwidth, Credo Technology sits directly in the middle of a rapidly expanding market. The company's stock performance has been extraordinary. Year to date, the stock is up more than 116%. Over the past year, it has surged over 247%. Over the last 3 years, it has climbed more than 890%, and over 5 years, it has risen more than 11-fold. Compared to the S&P 500, Credo Technology is in a league of its own, and very few semiconductor firms have delivered anything close to this level of return. The financial growth behind these returns is just as extreme. From Q1 FY25 to Q1 FY26, revenue jumped from roughly $60 million to $223 million, a massive 273% year-over-year increase. Earnings per share grew more than 1,200% year-over-year and nearly 50% quarter-over-quarter. Analysts expect this momentum to continue, forecasting more than 600% EPS growth next year and more than 200% revenue growth. This is true hypergrowth, even by semiconductor standards. Wall Street analysts continue to strongly support the stock. Credo Technology currently holds a strong buy rating from 15 analysts. The average price target is around $160, while shares trade near $145. Analysts aren't expecting an immediate explosive rally because so much upside has already been priced in, but their long-term outlook remains very optimistic given the company's position in AI infrastructure. Credo Technology trades at extremely high valuation multiples, and understanding them helps explain both the enthusiasm around the stock and the risks. The price-to-earnings ratio is about 210 times, meaning investors pay $210 for $1 of earnings. Even the forward PE, based on expected future earnings, is 79 times, which is still very high. The price-to-sales ratio is around 45, far above the typical 5 to 10 range seen in most tech companies. The price-to-book ratio is over 30, meaning the market values Credo Technology far above the value of its current physical assets. And its EV/EBITDA multiple is roughly 181, a level usually reserved for companies expected to grow cash flow dramatically. Compared to the broader semiconductor industry and its direct competitors, Credo Technology is significantly more expensive across almost every metric. These valuations show that investors have extremely high expectations. If the company delivers the growth Wall Street expects, the valuation could be justified. If growth slows even slightly, the stock could decline quickly. High valuation means high expectations, and high expectations bring high risk. Despite being in hyper-growth mode, Credo Technology is both profitable and financially secure. The company has a profit margin above 20%, a gross margin of 65%, and a return on equity near 19%. It also has outstanding financial strength with nearly $480 million in cash and almost no debt. Its high liquidity ratios give the company flexibility to continue scaling without financial stress. One of the biggest recent catalysts for Credo Technology was the appointment of Brian Kelleher, the former senior vice president of GPU engineering at Nvidia, to its board of directors. This is a major credibility boost for the company. Kelleher helped build Nvidia's GPU computing era, which is the foundation of today's AI revolution. His expertise in accelerated computing directly supports Credo Technology's strategy. The stock surged more than 20% in the week following the announcement, because investors saw this as a strong validation of the company's long-term roadmap. Even with all the excitement, Credo Technology is not a low-risk investment. The valuation is extremely high, leaving little room for error. The stock is very volatile and tends to move sharply in both directions. The company must maintain exceptional growth to justify its current valuation. While its margins are strong, they still fall short of companies like Nvidia. There has also been notable insider selling that investors should monitor. Altogether, Credo Technology is a high-reward, high-risk AI play. Credo Technology is one of the most compelling hyper-growth stories in AI infrastructure right now. The company delivers explosive revenue and earnings growth, backed by strong profitability and an excellent balance sheet. The hiring of a former Nvidia engineering leader further strengthens the company's credibility and strategic direction. However, the valuation is extremely high, expectations are enormous, and volatility is guaranteed. If you believe in the expansion of AI data centers and you're comfortable with higher risk, Credo Technology is a fascinating company to follow. If you prefer stable and predictable investments, this may not be the stock for you. Thanks for watching, and I'll see you in the next one.